So we have been providing coaching to NET and JRF students since the year 2012. We have a 60% success ratio for JRF students and 80% success ratio of NET students. Talking about myself, my name is Riddhi and currently I am pursuing my PhD from Faculty of Management Studies, University of Delhi. So as I was saying that today we will discuss about derivatives. Now derivatives is a branch of finance and also we say that it is a part or a topic of your paper 2 of your management module. Now students find it very difficult to understand what derivatives basically are. Whenever we read books or go to different websites, the simple definition of derivatives that we get is that it is a complex financial instrument. Now, as soon as we get to know about this definition of derivatives, we stop understanding it any further and we leave it and go. But believe you me, that derivatives is a very simple topic and we can understand it very easily. So beginning with today's class, the meaning of derivatives is that it is a financial instrument that derives its value from some other asset. So as you can see the term derivatives itself, it says that it has derived its value from something or it has taken its value from something. Now this something is an underlying asset which we will understand further. The value is derived from the value of one or more variables related to underlying asset in a contractual manner. And hence derivatives is actually a contract, it is not an asset. So simply, let us take an example. If I'm talking about Reliance Industries Limited, I have been following the news and reading the budgets throughout. Now I know that the government is focused on green energy, sustainable energy, greener vehicles, and that is why the Reliance's main business, which is oil refinery and petroleum products, that seems to be in danger. All I know is that the value of the Reliance share will now go down in the stock markets. So I want to take opportunity of this activity which will happen, but I do not have Reliance shares with me which I can sell in the markets. And if I want to go to the stock market and buy a Reliance share, it will be of around 3,000 rupees. Now this will be very difficult for me. So what I can do is I can find a similar person who has an opposite view about Reliance Industries. Maybe who is thinking that Reliance is going to change the way they are doing their business. They will get into greener and sustainable energy business. And therefore, they think that the share price of Reliance will go up. So I will enter into a contract with that particular person and say that I want to sell Reliance, and the other person says that they want to buy Reliance before the share price shoots up. So that is how we will enter into a contract and we will form a derivative. Now, derivatives cannot be of shares only, they can be of different underlying assets. So you can have equities, you can have debt, you can have bonds, you can have currencies, and you can have indices which have their own derivatives. So, for example, if you see Nifty 50 and Sensex, which are the two major indices in our country, they have their own derivatives. Then agricultural produces such as grains, coffee, pulses, and cotton, they also have their own derivatives. Metals such as gold, silver, copper, and aluminium also have their own derivatives. Energy sources such as crude oil, natural gas, electricity, and coal also have their own derivatives. We also have derivatives for interest rates. Now, why do we need to trade in derivatives? Basically, there are two reasons why derivatives are important. First one is that they are a hedging tool, and second, because they are a speculation tool. Now, what do you mean by a hedging tool and a speculation tool? So, a hedging tool is which is used when you want to reduce the risk that is there in the market, or you want to control the amount of losses which you might have to bear in the future. And what do I mean by when I say it is a speculation tool? One thing more that you need to know right now is whenever I'm talking about equity markets specifically, because derivatives are mostly traded in the stock exchanges. So stocks are very expensive. So if you see the stock of MRF, it has already crossed rupees 1 lakh per share. Similarly, the example which I was taking of Reliance Industries, the stock price of Reliance is also nearing 3,000 right now. Now, I cannot individually, being a retail investor, go to the stock market and buy as many shares as I want because there is a limit of money that I have and that I can spend. Hence, derivatives is a segment is used so that I can capture those gains in a particular share if I want to. And also at the same time, what I can do is I can hedge against any kind of risk in my stock position, which will happen in the future. So as it is written in the slide, that derivatives helps as a risk management tool for anyone having an underlying risk exposure based on the future price of a financial asset or a commodity. It works on the principle of transferring the price risk from one party to another who is willing to take the risk in anticipation of financial benefits in the future. So this point basically means that there are two parties, party A and party B. So party A has an opposite view. They think that the stock price will go up, and party B has an opposite view. Against party A, they think that the stock price will come down. So basically, this differentiation in their view leads to financial benefits to any one of the parties in the future. And the third thing is derivatives market helps in improving price discovery in the market. Then there are four types of derivative contracts basically. Now you must have understood what a derivative means. Something which has derived its value from an underlying asset. Basically a contract which has derived its value from an underlying asset. So four types of your derivative contracts are forwards, futures, options, and swaps. So in this particular session, we will be talking about the first two types only, that is your forwards and your futures. Now, what is a forward contract? So a forward contract is a customizable derivative contract. It is an UGC derivative contract. We must have heard about it. So we'll understand this with the help of an example. Let's say that there is a person A and there is a person B. Now, person A is a jewelry designer and person B is a gold merchant. So, jewelry designer will always require gold, and gold merchant is the person who will always want to sell gold to somebody. So, what is going to happen is that A, who is a jewelry designer, thinks that in the near future, or maybe after 3 months, you can say, the price of gold will go up. And if he or she wants to make jewelry, so he or she should buy gold right now only. So he or she contacts B, who is a gold merchant, and says that I want to buy few kilograms of gold from you. Now, B, who is a gold merchant, thinks that in the next 3 months, because of different conditions which are ongoing in the market, the price of gold will go down. So I do not want to incur any loss, and I also want to have some profit. So now these two parties are of different views. They will come into a contract. A, who is a jewelry designer, is thinking that the price will go up, and B, who is a gold merchant, is thinking that the price will come down. So they say that let us lock the price of the gold on today's date only. Make sure that we buy and sell this gold, which for which we will enter into the contract after 3 months. Now, both of them think that they are in profit as of now. That is why we say that forward contracts are OTC or over the counter contracts because these are two individual parties who have met on their own. There is no regulator which is controlling their forward contract. There is no kind of person who is saying that both of them will perform their contract or duly discharge their contract. And hence, these people are entering into a forward contract. Now here in this slide, we have a different kind of example for forward contract. So we say that there is a farmer who wants to sell wheat to a bread maker. Now bread maker is thinking that the price of wheat will go up in the near future, and farmer thinks that the price of wheat will go down in the near future. So farmer wants to lock the price of its wheat that he wants to sell, and the bread maker also wants to make sure that he does not buy wheat at a higher price after 3 months when he will be requiring it for making bread. So what do? They agree to sell 500 kgs, sell and buy 500 kgs of wheat at rupees 40 per kg after 3 months. So let's say this 40 per kg is the current market price of wheat which is going on the market. Now, what just happened after this forward contract is that the farmer is also happy and the bread maker is also happy. Because the farmer thinks that after 3 months, the price will go down, and so he is happy he has sold it at the current price only. And the bread maker thinks that after 3 months, the price will go up, so he has secured wheat at a lower price as compared to then. Now, 3 months later, what are they doing is that the farmer is giving 500 kgs of wheat to the bread maker, and the bread maker is paying rupees 20,000 to the farmer. But a forward contract is not that simple. So it has certain kind of limitations which will follow now. There will be different kinds of risks. First will be the default risk. So as I mentioned that no one is going to cover this contract between these two parties. So if after 3 months the price of wheat in the market rises, it goes to rupees 50 per kg. Now the farmer would want that I sell it at rupees 50 per kg. Why do I sell it at rupees 40? So what he will do is he will not honor this contract with the bread maker, and instead he will go out in the open market and sell this wheat at rupees 50 per kg to somebody else. So there is a default risk. Second kind of risk which will come is liquidity risk. Now, the buyer may not be able to provide adequate cash to execute the contract. Let's say the bread maker says that in the past few months or in the past few weeks, I did not make enough sales. Now I do not have rupees 20,000 to pay to you, to the firm. Then again, there is nobody who is going to question the bread maker. Third is your rigidity. Now, halfway the parties might feel that the situation might change, but they cannot foreclose the agreement halfway. So they have made the agreement for the next 3 months. They think that the situation might change, but then they will not make they will not honor the contract earlier than the period of 3 months. So in order to control or in order to, reduce the risks of a forward contract, a future contract was introduced. Now, everything is same between a forward contract and a future contract. That is to say that their transactional nature is the same. Same thing is happening that two parties which have a opposite view, they are entering into a contract for a particular period of time and on a particular date for a particular amount. Everything is the same. Only the difference is that the forward contracts are over the counter or the OTC contracts, and your future contracts are regulated by the stock exchanges. So future contracts are between two parties with opposing views. Same goes with the forward contract also. That means if I buy TCS in the future, I am bullish about the stock and the person selling will have bearish views. Again, this is the same thing. If you are buying a future of a particular stock, it means you are bullish about it. That you think that the prices will go up, and when they will go up, you will sell it. And the person selling will have bearish views. They think that the price will go down. In forwards, a party might default, but futures are regulated by SEBI. That is what I said. There is a presence of a regulator. The exact date of execution of the contract is determined in the forwards, but it is not determined in the futures. So what happens is that there is a time span of 3 months of a future contract. If you wish to execute the future contract on any date between among those 3 months, you can do so. And I can sell my future derivative at any time within these 3 months. So this solves the problem of rigidity which we were facing in the forward contracts. Now, due to availability of numerous buyers and sellers in the markets, futures possess high liquidity. So since it is happening on a stock exchange, there will be numerous parties who have different view to your view, and hence there will be many people who will be willing to buy or your future contract. So future contract, just like forward contracts, they are used to take the benefits of hedging and speculation, as we discussed earlier. These contracts are entered into so that they can be executed on a future date. The difference is that futures can be traded on a stock exchange in two different ways. One is going long and the other is going short. So going long means that you are buying it because you have a bullish view. Going short means you are selling the future because you have a bearish view of the underlying asset. So that was all for today. Thank you for today's session.